Most people will spend 40 years waiting for the stock market to set them free. They will contribute faithfully. They will diversify responsibly. They will watch the balance grow and shrink and grow again, and they will wait, because that is what they were taught. Accumulate. Be patient. Retire at 65 and then, finally, start living off what you built. That is not an investing strategy. That is a delay tactic dressed as wisdom. Because there is a category of stocks, not exotic, not risky, not reserved for hedge funds or inherited wealth, that does something the average investor has never been shown how to use. They do not just grow in value over time. They pay you, regularly, predictably, in cash, directly into your account, whether you are watching the market or not, whether the economy is expanding or contracting, whether you are working, or sleeping, or sitting on a beach in Lagos. And the gap between what most people know about these stocks and what they could be doing with them is not small. It is the difference between waiting 30 years for permission to stop working and engineering that outcome in a fraction of the time. Before this goes further, the position here is not neutral, and you should know what it is. The financial industry has a structural incentive to keep ordinary investors in accumulation mode. Brokerage platforms, retirement account frameworks, and mainstream financial media all benefit when investors think of income as something that happens after the portfolio is big enough. That framing serves the industry. It does not necessarily serve you. What follows is built on a different premise entirely. There is a term most retail investors have heard, but few have taken seriously: dividend-paying stocks. The word dividend gets dismissed in certain circles as boring, conservative, something your grandfather's financial advisor recommended alongside government bonds and a pat on the shoulder. That dismissal is one of the most expensive mistakes an investor can make. Here is what a dividend actually is. When a company generates profit, it has choices about what to do with that money. It can reinvest it, it can buy back its own shares, or it can distribute a portion of it directly to the people who own the stock. That distribution, that cash payment to shareholders, is the dividend. Now here is what most people were never told. The wealthiest investors on earth do not primarily measure their portfolio by its total value. They measure it by how much income it generates per year. The number they care about is not the account balance, it is the cash flow, and they build toward a specific target, the point at which that cash flow equals or exceeds their annual expenses. When those two numbers cross, work becomes optional. That crossing point has a name in serious financial circles. It is called financial independence. And the fastest reliable path to it runs directly through dividend income, specifically through a category of stocks that were built to generate it consistently. If you have been watching your account balance grow for years without asking what it is actually paying you per month, this is the moment to stop, because the math is about to look different than you expected. Not all dividend stocks are built the same. The investor who picks randomly from a list of high-yield tickers will get burned. The investor who understands the three core categories and what makes each one behave differently has a genuine system. Category 1. Dividend Aristocrats. These are companies that have increased their dividend payment every single year for a minimum of 25 consecutive years. Not maintained, increased. Think about what that means practically. These are companies that paid through the 2008 financial crisis, through the 2020 pandemic collapse, through every recession, correction, and moment of market panic in the last quarter century. And every year, without exception, they raised the amount they paid to shareholders. A study published by S&P Dow Jones Indices found that Dividend Aristocrats outperformed the broader S&P 500 on a risk-adjusted basis over multiple decade-long periods. They did not just survive, they compounded. And they paid while they compounded. The mechanism behind this consistency is not luck. Companies that can raise dividends through economic downturns typically have three things in common: pricing power that protects margins regardless of inflation, diversified revenue that insulates them from single-sector shocks, and management cultures built around shareholder return as a core commitment rather than an afterthought. You are not buying volatility when you buy these. You are buying a track record. Category 2. REITs. A real estate investment trust is a company that owns income-producing real estate, apartment buildings, commercial properties, data centers, healthcare facilities, and is legally required by the Internal Revenue Service to distribute at least 90% of its taxable income to shareholders every year. 90%. That is not a policy. That is a legal obligation. These companies are structurally built to pay you. The average retail investor hears real estate and thinks about down payments, mortgage applications, and the headache of becoming a landlord. REITs eliminate every one of those barriers. You buy the stock, the company manages the properties, you receive the income. Certain REIT categories have delivered dividend yields consistently between 4 and 8% annually, sometimes higher, while providing inflation protection that most bond investments cannot match. When rents rise, REIT income typically rises with them. The underlying assets appreciate, the distributions increase. Here is where the attention needs to go, because this is the part most investors skim past without understanding what it means. A REIT with a 5% yield held in a tax-advantaged account and reinvested through a dividend reinvestment plan compounds differently than almost anything else in a retail investor's portfolio. The yield does not just pay you, it buys more shares. More shares generate more dividends. More dividends buy more shares. The acceleration is nonlinear once the base is large enough, and the base grows faster than most people model. Category 3. Business development companies. This one is genuinely underused, and the reason it stays underused is exactly the dynamic described at the opening of this video. A business development company, a BDC, is a publicly traded entity that lends money to small and mid-sized private businesses that cannot easily access traditional bank financing. In exchange for that access to capital, these companies pay high interest rates. The BDC passes the majority of that income directly to shareholders. Like REITs, BDCs are legally required to distribute at least 90% of their taxable income. Yields in this category have historically ranged from 7 to 12% or higher, depending on market conditions. The risk profile is different from Dividend Aristocrats. These companies are exposed to credit risk. If their borrowers default at elevated rates, the income stream takes damage. This is not a category to hold in isolation. It is a category to hold as a component of a diversified income portfolio, where its higher yield compensates for its higher sensitivity to economic cycles. But for the investor who understands how to use it, and who has taken the time to evaluate the quality of a BDC's loan book rather than just its yield, this is one of the most powerful income engines available to anyone with a standard brokerage account. Right now, somewhere in this video, you are either doing the math in your head or you are feeling the pull to dismiss this as too simple. If it is the latter, hold that skepticism. It is about to get more useful. Here is the exercise that changes the way serious investors look at their portfolio. Take your current annual expenses. Every bill, every subscription, every meal, every school fee, every tank of fuel. Add them up and arrive at one number, the amount of money you need to cover your life for 12 months. Now ask a different question than the one you have been trained to ask. Most investors ask, how large does my portfolio need to be before I can retire? The better question is, how much income does my current portfolio generate per year, and what is the gap between that number and my annual expenses? The gap is the target, not the total portfolio value, the income gap. Because once that gap closes, once the cash flowing out of your investments every year equals the cash flowing out of your life every year, the equation changes permanently. Work becomes a choice, not a necessity. A portfolio of $100,000 generating a conservative 5% annual yield produces $5,000 per year in passive income. That is not life-changing on its own, but a portfolio of $500,000 at the same yield produces $25,000 per year. A portfolio of $1 million produces $50,000, and for a large portion of the people watching this right now, $50,000 per year in passive income, in a country where that number represents a significant annual salary, is not a distant fantasy. It is a specific target with a specific path. The question is not whether the math works. The math has always worked. The question is whether you have been shown how to run it in the direction that actually serves you. This is the watch-through reward. The thing that changes the model entirely for anyone in an early accumulation phase. Most dividend investors think about yield as the end goal. Get the yield high enough and collect the income. What they underweight, dramatically, is what happens during the years before the income is needed. Dividend Reinvestment Plans, commonly called DRIPs, allow investors to automatically purchase additional shares with every dividend payment rather than receiving the cash. On the surface, this sounds minor. Compounded over a decade or more, it produces one of the most powerful effects in personal finance. Consider this. An investor who purchases $10,000 of a Dividend Aristocrat with an initial yield of 3% and an average annual dividend growth rate of 7%, a conservative figure for the category, and reinvests every dividend for 15 years, does not simply end up with a portfolio worth more than $10,000. They end up with a portfolio where the yield on cost, the dividend income as a percentage of the original investment, has expanded dramatically beyond that initial 3%, because the dividend per share has grown every year for 15 years, because the reinvested dividends purchased additional shares, because each of those additional shares is now also receiving the raised dividend. The original investment is no longer paying 3%. It is paying a much higher effective yield on the original capital, while the underlying shares have also appreciated in value. This is the compounding mechanism that wealthy investors have understood for generations. It is not complicated. It is not insider knowledge. It is arithmetic applied in a direction most retail investors are never shown. The strongest counter-argument to everything in this video deserves to be stated plainly. Dividend investing is not the fastest path to wealth. If the goal is maximum portfolio appreciation over a 10-year window, and the investor has the risk tolerance and the time horizon to hold through significant volatility, a growth-focused strategy, concentrated in high-multiple technology or emerging market equities, will likely outperform a dividend-focused portfolio in pure capital terms. That is a real trade-off. The counterpoint is equally real. A portfolio built for capital appreciation generates nothing until it is sold. It cannot replace income without liquidation. It is entirely dependent on market conditions at the moment the investor needs to access funds. And for every story of a growth investor who timed the exit well, there are quieter stories of investors who needed liquidity during a correction and sold assets at 30% below their peak value. The dividend income model does not require perfect timing. It does not require the market to cooperate on any particular day. It pays, regardless of whether the portfolio is up or down that month. And for the investor whose primary goal is not maximum wealth accumulation, but income replacement, the freedom to stop trading time for money, the dividend model solves the problem more reliably than almost any alternative. The practical entry point is simpler than most financial content will tell you. An investor starting from zero does not need to identify individual stocks. The category of funds called dividend-focused ETFs, exchange-traded funds that hold diversified baskets of dividend-paying stocks, allows immediate exposure to the income model without requiring stock selection expertise. Funds that track the Dividend Aristocrats Index, REIT-focused ETFs with diversified exposure across property sectors, BDC-focused closed-end funds for investors who want higher yield with managed credit risk. The natural disclaimer belongs here, stated plainly. Nothing in this video is personalized financial advice. Tax treatment of dividends varies by country, account type, and individual circumstances. Before building a dividend-focused portfolio, the investor who takes this seriously will consult a qualified financial professional who understands both their goals and their tax situation. The concepts here are educational. The execution is personal. With that said, the structural framework is available to anyone who chooses to engage with it. No accreditation required, no minimum balance gate, no invitation from a private wealth manager, a brokerage account, a consistent contribution, a reinvestment instruction turned on, and the discipline to let the compounding run. Here is the cost of this information. Once the income gap framing replaces the net worth framing, Once the question shifts from how large is my portfolio to how much does my portfolio pay me per year, the accumulation model most investors are running starts to look different. Not wrong, exactly, but incomplete in a way that is difficult to unsee. Every dollar sitting in a growth-focused account that generates no income is a dollar that is working toward a future sale rather than a present cash flow. Every year of the reinvestment window that passes without a dividend strategy in place is a year of compounding that cannot be recovered. That is not designed to produce guilt. It is designed to produce a recalibration. Because the investor who starts this model at 35 and the investor who starts it at 45 will reach the income crossover point in very different timeframes. And the only difference between them, most of the time, is when they first encountered the framework. You just encountered it. What you do with it is the only question that remains open. If the income gap model just reframed how you think about your portfolio, that reframe is worth saving. The specific framework here is something you will want to come back to the next time you are looking at your account and asking whether it is actually working for you. The person in your life who is still asking, how much do I need to retire, without asking, how much does my portfolio pay me right now? This video is the conversation they have not had yet. The question this video could not fully answer. If dividend income replacement is this accessible, why does mainstream financial media spend so little time on it? And what does that pattern of omission tell you about whose interests are actually being served? That question has an answer. It takes its own video to give it properly. If you want that video, you know what to do. And in the comments, one question. What is your current annual passive income from your portfolio? Not your balance, your income. If the number is 0, say 0. That honesty is the beginning of a different kind of math.